Stop scrolling. Gold just blinked. Overnight spot prices slipped back below $2,220 after riding near record highs for weeks. Stronger jobless claims data hit. Risk appetite snapped back. Geopolitical tension around Greenland eased after comments tied to Donald Trump softened tariff rhetoric. Headlines are calling it profit taking. That's not the full story. Beneath the price action, something else is happening. Central bank accumulation hasn't slowed. Physical premiums in Asia are still stubbornly bid. Futures positioning is stretched, but it's not unwinding cleanly. That divergence is the tell. If you're holding gold right now or watching it or stacking it quietly, this moment matters more than the last 6 months because you're about to hear two patterns that repeat every single cycle. And by the end, you'll have a simple watch list you can use this week to separate noise from structure. Here's the real question. Is this dip routine or a warning most people won't see until it's too late? Let's find out. Before we go any further, if you're not subscribed, now's the time. You're stepping into the group that watches flows, not headlines. We don't chase price. We track what institutions do quietly, what markets reveal when no one's paying attention, and what shows up in positioning before it shows up in sentiment. This is the group that doesn't get shaken out. So what actually happened? Gold pulled back from near record territory after stronger U.S. economic data surprised to the upside. Jobless claims came in better than expected. Growth optimism ticked higher. Risk assets caught a bid. The dollar firmed slightly. Gold eased. On the surface, that makes sense. When macro fear fades, safe haven demand cools. That's textbook. But here's the hidden layer most people miss. Despite the price softness, physical demand in key regions hasn't cracked. Central banks, the slow, unglamorous accumulators, are still buying. Goldman Sachs hasn't revised its long-term $5,400 gold target for 2026. COMEX open interest is elevated, but it's not collapsing. That's the divergence. Fast money is reacting to headlines. Slow money is still stacking on weakness. And if you don't understand the difference between those two timelines, you're going to misread every signal that matters over the next month. If you're tracking gold right now, comment watching. Not financially, mentally. Because the next phase will test conviction harder than price ever will. Now let's talk about the first mechanism at work. Think of this like a pressure valve. When macro fear builds for weeks, leveraged money piles into gold. Futures contracts stack. ETFs absorb inflows. Positioning gets crowded. Everyone leans the same way. Then something shifts. A data print surprises. A geopolitical headline softens. Risk sentiment flips even slightly. And the pressure valve releases. Fast money doesn't wait to see if the news sticks. It exits. Futures unwind. Algorithms trigger. Price drops sharply and emotionally. But central banks don't react to jobless claims. Long-term allocators don't chase headlines. Physical buyers in India and China don't care about 1 week of U.S. data. So while leveraged traders are dumping contracts, long-term buyers are absorbing quietly. That's the valve. Leverage leaves first, conviction stays. This pattern repeats every single cycle. Look at the move we just had. Gold ran from roughly $2,600 in late March to nearly $2,150 by mid-April. That's a $350 move in about 3 weeks. Crowded doesn't even begin to describe it. Macro tourists piled in, trend followers chased, retail breakout traders jumped aboard, then stronger data hit. Risk appetite returned. The valve opened. I'm not telling you this is bullish or bearish. I'm showing you the mechanism so you recognize it the next time it happens. Because here's the mistake almost everyone makes in this phase. They assume price direction equals conviction direction. It doesn't. Price reflects the loudest participants on the shortest timeline. Right now, that's leveraged futures traders reacting to headlines. But conviction lives in slower moving flows. Central bank disclosures that show up months later, physical premiums that don't budge, ETF outflows that reverse within days. Let that sink in. The market can drop 3% in 2 days while the underlying structure stays completely intact. And if you're watching price instead of positioning, you'll panic out of a trend that never actually broke. Here's the line to remember. Leverage reacts first, structure adjusts slowly. Your job isn't to predict whether gold bounces tomorrow. Your job is to recognize when the market is testing conviction versus when it's breaking structure. Right now, it's testing, not advice. Pattern recognition. If this were a true structural breakdown, you'd see COMEX open interest collapsing alongside price. You'd see physical premiums in Shanghai and Mumbai cracking. You'd see central bank buying slow or reverse. You'd see ETF outflows accelerate and persist. None of that is happening cleanly yet. What you're seeing is fast money flinching. And that leads us to the deeper layer. There are two timelines operating in gold right now. Timeline one is fast money, hedge funds, algos, retail momentum traders. They react to data, headlines, and sentiment shifts. They're leveraged, they need liquidity. Timeline two is slow money. Central banks, sovereign wealth funds, long term allocators, physical stackers. They don't care about one data print. They think in quarters and years. Most of the time, these timelines don't clash. But during moments like this, when fear eases suddenly after weeks of buildup, they collide. Fast money sells because the narrative shifted. Slow money buys because price dipped. The result is choppy, confusing price action that shakes out anyone who doesn't understand what's happening underneath. Picture it. You're a macro hedge fund. You went long gold 3 weeks ago on tariff fears, debt concerns, and geopolitics. You're leveraged. You're up nicely. Then jobless claims surprise to the upside. Growth optimism ticks higher. Your risk manager taps you on the shoulder. You're not married to gold, you're married to returns, so you exit. Fast. Now, switch perspectives. You're a central bank reserve manager in Asia. You've been diversifying away from US Treasuries for years. Gold is part of a multi year strategy. Gold dips 3% in 2 days. You buy more. Same asset, same moment. Completely different behavior, and here's the danger for retail participants. The price you see reflects the fast money timeline, but the structure you're trying to trade is built on the slow money timeline. So when price drops, it feels like the trend is breaking, even when nothing structurally changed. That's the trap. Watch for the tells. If ETF outflows spike, but physical premiums in Shanghai stay elevated, that's the time split. If COMEX open interest drops but central bank disclosures keep showing accumulation weeks later, that's the time split. If institutions like JP Morgan and UBS maintain long-dated bullish targets while short-term traders dump positions, that's the time split. Your job is to know which timeline you're operating on, not which one is right, just which one you're trading. Here's the scenario most people miss. Fast money keeps unwinding for another week. Price grinds toward $2,850. Headlines turn bearish, retail sentiment flips, but physical premiums don't crack. Lease rates tick higher quietly. Central banks keep absorbing supply. That's what happens when slow money absorbs everything fast money sells. And when that absorption is complete, when there's no more leveraged length to unwind, price snaps back faster than anyone expects. That's when faces get ripped off. Not advice, just mechanics. So where does that leave us right now? This isn't about buying or selling. It's about recognizing whether the market is testing conviction or breaking structure. Most people are asking the wrong question. They're asking, should I buy this dip? Or is gold going higher? The real question is simpler and harder. Are the flows that drove the trend still intact, or have they reversed? If flows are intact and leverage is unwinding, you're watching a healthy correction. If flows reverse, you're watching the beginning of something far more dangerous. We don't know the outcome yet, we only watch structure. And that brings us to what actually matters this week. Here are the paths, not predictions, just logic. One path is a grind lower. Fast money keeps unwinding. Data stays firm. Gold drifts toward 2,800. Painful, but clean. Another path is sideways absorption. Price chops. Volatility compresses. Slow money soaks up supply. Boring until it isn't. The third path is a sharp rebound. Data weakens. The dollar slips. Geopolitics flare. Gold snaps back above $3,000 in days. No forecasts, just frameworks. So here's the watch list. First, COMEX open interest versus price. If open interest falls with price, that's liquidation. If it holds steady while price dips, that's absorption. Second, gold lease rates and the forward curve. Rising lease rates during price weakness mean physical tightness. That's a quiet but powerful signal. Third, ETF flows. Watch vehicles like SPDR Gold Shares and iShares Gold Trust. Sustained heavy outflows mean fast money leaving. Quick reversals mean conviction holding. Fourth, the dollar's reaction to data. If strong data hits and the dollar weakens, that's telling you something bigger is at play. Fifth, central bank purchase disclosures. They lag, but when they show up, they reveal what slow money was doing while everyone else panicked. And finally, know the risks. A hawkish surprise from the Federal Reserve, a sustained dollar breakout, a sudden resolution of geopolitical risk, a coordinated slowdown in central bank buying. You can't eliminate risk, you can only track it. If you're a trader, respect the chop. If you're a long term holder, respect the structure. If you're stacking physical, understand whether this dip is opportunity or warning. Frameworks, not advice. Let me close it like this. If you're watching flows instead of headlines, structure instead of noise, and timelines instead of candles, you're already ahead. Because most people panic during moments like this. They sell into absorption or hold through breakdowns because they never learn the difference. You're not the crowd. You're in the group that understands that price moves fast, structure moves slow, and wealth follows structure. So here's the question I want you to answer below. Are you treating this dip as opportunity, or are you waiting for more clarity? No judgment, just perspective. And if you've lived through cycles where fast money panicked and slow money stacked, share that story. Someone newer needs to hear it. Hit subscribe if you're not already in. We don't predict. We watch, we track, and we don't get shaken out. Final insight to take with you. Price moves fast, structure moves slow, wealth follows structure. See you in the next one.